for the invitation. This has been a great conference. This is joint work with Fernando Alvarez, Francesco Lippi, Diana Van Patten, and Esteban Mendez of the Central Bank of Costa Rica. And this paper is about technology diffusion. So many of you have seen this graph before. This is the classic S-shaped curves of adoption of hybrid seeds of corn in the United States from Greeley's 1957. This is basically the standard model of technology adoption. We have this gradual adoption of technologies. And why are people or farmers adopting technologies? Well, because the costs of these technologies are dropping over time. Now, new technologies don't behave like that. Why not? Because of network effects. So think about social media. The benefits of adopting Facebook depend on how many of my friends have Facebook. Think about payments app, which I'm going to be talking about. The benefits of me having Venmo or any other app, it's basically the amount of friends that I have so that I can send them money to. So working with network effects is a little bit difficult. You have to track before you decide to adopt, you have to track what other people are doing. You have multiple equilibria. So what we do in this paper is basically we develop a model of technology adoption with strategic complementarities. Why do we need a model? Well, because the adoption decision today depends on whether I expect more of my friends to be adopting this technology in the future. So I need to be forward-looking. It doesn't only depend on the past, whether the costs are going down, but also about the future, right? So what we have in the model is that people look ahead, and then if they expect a lot of their friends to be adopting the technology, then they go ahead and they adopt this technology, and then adoption is fast. But if they expect their friends are going to wait, well, then you wait as well, and then you have this gradual diffusion of the technology. So that's what we're going to do in this paper. The second reason why we need a model is because, of course, there is externalities in this type of goods. When you adopt a technology, you do not internalize that you're benefiting others by adopting this technology because you're expanding the network in this app. So of course, there is an externality, and somebody like a planner or like a government or even a private sector firm could design a subsidy, an optimal subsidy to actually improve the adoption of this technology. And these subsidies can have large effects. Small technology can unravel all this adoption of this technology. So we're going to write a simple model to derive an expression of this subsidy. Now, I'm not going to go over all the details of the models. I have two equations I want to show you. And so let me just define three objects for this talk. X is going to denote the benefits of adopting this technology. So it could be that you go to Starbucks and you really want to use Venmo. Okay, you have high X. Or it could be that you have really close friends, so you have high X. So this is your idiosyncratic benefits of having this technology. Second, N, it's going to be your friends. How many of your friends have this technology? It could be your neighbors, your coworkers, your family members. When I go to the data, I'm gonna try to compute N. So the benefits of adopting this technology, I can decompose it into X times this parameter that I'm going to call theta 0. Theta 0 is all the benefits that the app gives you. It could be the app is very nice. You can import the list of your contacts. You can pay taxes with your app. So this is a parameter that we can actually measure in the data. The second part of the benefits of adopting this technology are these network externalities. So the benefits of this technology, you can see that they increase if more of your friends have this technology. And they depend on this parameter called theta n. And that's something that I want to find evidence in the data that it exists. So basically, if more of your friends adopt this technology, are you more likely to adopt? Are you more likely to use it more? So this is my slide of the model. You also have to pay a fixed cost to adopt this technology. And this is going to be useful because in the data, we're going to see that people that really want to use the app adopt first. So they are willing to pay this cost first. Okay, so that's my model. Okay, so how do we solve this model? Well, these agents take this, look ahead, look at the path of n, and then they decide whether to adopt. And in the adopt on decision, it's some threshold x bar. And then I have to aggregate all the decisions of the agents to get an n, and then I solve this fixed point. Now, these models, if you're interested in the solution method of these models, they're a little bit tricky because of the multiplicity of equilibria. You have to prove existence. This is a mean field game. So if you're interested in the details, just look at the paper. Today, we're not going to look at that. But this is the essence of the solution. And let me just show you what are the mechanisms with an example. Suppose all the agents in my economy are in this rectangle, and everything that is pink are the people that do not have this technology yet. So I have X here. So if you are here on this side of this rectangle, you really like this technology. You really want it. If you're on this side, you don't want it. And then the Central Bank of Costa Rica drops this technology, this app, this peer-to-peer payments technology. At the very beginning, some people are gonna adopt, the high X people, but over time, N is gonna keep increasing over time. So adoption is gonna increase more and more and more up until I find an equilibrium. But you can already see here how I get gradual adoption of this technology through the strategic complementarities mechanism. This is gonna be relevant because this is how I'm gonna get the S-shaped curve that we see in other technologies. Okay, so that's the mechanism of the model. The solution of the model is very simple. If the costs are very low relative to the benefits of the technology, of course, there's an equilibrium where people adopt. This is the tractors model, the laundry machines model, the horses. Costs are low, you adopt the technology because it's beneficial, right? More interestingly, there could be some large complementarities. And then in those cases, we can have multiple equilibria. So you have an equilibrium where people adopt and an equilibrium where people do not adopt. So think about this. You're deciding whether you adopt this technology or not. You look ahead, and then you don't expect people to adopt this technology. Well, then you're trapped in a no adoption equilibrium. But if you look ahead and you think people are going to adopt in the future, you can go to a high adoption equilibrium. Why is this relevant? Because when we go in the data or we see the experience of different countries, for the same initial conditions, some countries adopt these technologies and some countries do not. So think of Brazil. They launched this peer-to-peer technology and how much 60% of people are using it. Think of El Salvador. They actually gave a $30 incentive to download an app, and now people are not using this technology. Mexico is another case. India is on this side. So we wanted, this multiplicity is a feature, not a bug. Okay, so that's it. Last thing I want to say about the model is the subsidy. The subsidy, it's somebody, the planner comes in and says, okay, there's an externality. There are a whole bunch of benefits left on the table because you guys are not internalizing that you're benefiting each other when we use this app and you adopt this app. So the planner is going to come and solve this problem. And what's going to be the optimal subsidy? Well, it's proportional to the externality, to the benefits that are left on the table. So that's the subsidy is what the planner is going to rebate to people to increase the adoption. And you can see the formula, like super simple. It's my parameter of complementarities, the number of people that have adopted, and the average benefits of the people that have adopted this technology. Okay, so it's easy to implement. It doesn't vary by your income or your X. It increases over time. It's a simple implementation. Now, the name of the game for me is to figure out how to estimate this theta N and how to estimate N. So we're going to partner with the Central Bank of Costa Rica. The Central Bank of Costa Rica launched this technology called Simpe Móvil in 2015. Now it covers 60 to 70% of the population. 10% of GDP goes through the app. It's very much like central bank digital currency. It's peer-to-peer technology. Most people are using it, sponsored by the central bank. And we're going to use data for this technology to try to measure the objects in my model. What is my goal? My goal is to construct measures of networks, N. So this could be your friends, your family, your coworkers. I want to create measures of adoption and use, your number of transactions. I want to know if people that really want the app adopt first, so selection. And I want to measure theta N, because that's the parameter that determines whether we have multiple equilibria, whether I need to subsidize people. Theta N is the key parameter here. Okay, so what's the data that we have? So we have pseudonymous identifiers of all these data sets. Mainly, we have the transaction level data, the universe of transactions for this app in Costa Rica. So we have information of the senders, the receivers, the transaction size. The data from this app, we're going to link it to a bunch of other individual level data sets. Family networks, networks of coworkers from employer-employee data, and neighbors from the National Registry. All these data, people in Costa Rica have a unique identifier. It's anonymized, but it can be linked. So we have the universe of transactions for all the sample period of the app, and we can construct networks. Okay, so what are the stylized facts of this technology? Well, first, technology diffused gradually. It took actually 5 years to reach 30% of the population. And then now it's more than 60, 70% of the population. I'll show you the adoption graph, but it was gradual. Second, most transactions are peer-to-peer. And this is why you didn't see firms in my model. This is a very simple model. This is something we're studying now. Why are firms taking longer to adopt? But for now, we're thinking about peer-to-peer technologies. Third, not surprisingly, individuals belong to networks. They transact with people that they know. So 45% of their transactions are among coworkers, 41% among family members, 50% among neighbors. The union is 75%. So I'm going to construct these measures of networks, family, coworkers, and neighbors. So I'm going to capture 75% of the transactions. Third, there is some evidence of selection. It's actually fourth, evidence of selection. So what is selection? That people that adopt early, when their the networks is small, they actually end up using the app a ton. So that's because they needed the app, they wanted the app, they have high X. So how can you see that really easily? When you see the average wages of the users of this app declining over time, the average skills of the people that are using this app is also declining over time. The average age of the average user is increasing over time. And when you look at the early adopters, they're also transacting more on average. Lastly, strategic complementarities. To show you strategic complementarities, I want to know that if people in your network start using the app more or adopt the app, you transact more or adopt more, or are more likely to adopt. And here you see that if your neighbors go up, the share of your neighbors that have the app goes up, or your share of coworkers that have the app go up, or your share of relatives that goes up, well, you also transact more. This is suggestive evidence, is correlation. But what I really want to do is take one of you and put you in a different network and see what you do. If I put you in a network that has more users, are you more likely to adopt? Well, the answer is yes. So if I use mass layoffs, so you got fired for some exogenous reason, and if you move to a job that has more people using the app, you're more likely to adopt the app. And if you move to a job where less people have the app, you don't adopt this app. However, this is not evidence of complementarities, because this could be just learning. Somebody told you about the app. So what I do now is look at the people that already have the app, already have transacted with this app, and I look at what they do once they move to a job where they have more users of this app, and they transact more. So this is suggestive evidence, and they transact less when they move to jobs with less people using the app. So this is some evidence that complementarities actually matter, and this is how I can estimate my theta n. Now let me tell you how my model does relative to the data. So in red is the data, in black is my model. It's not perfect, but more or less, you know. So this is the diffusion curve of the technology in Costa Rica. If I extrapolate another 10 years, follow the black line, 85% of people, we predict that 85% of people will use this technology in 15 years. Now, look at the blue line. The blue line is my threshold of adoption. You can see that it's declining over time. Why? Because of the complementarities. If more people use this app, then there are more benefits there for other people, and then the marginal person has a lower and lower X. So this is the selection that I was telling you about. Okay, so that's how my model does. I have one more slide, which is what is the optimal level of adoption. I told you before, the black is it's a model close to the data, but what is the optimal level of adoption? The planner internalizes, there are externalities, there are some extra benefits left on the table, subsidizes adoption, but the blue line will be the planner. And the planner wants a lot more people to be adopting. In fact, the planner wants almost everybody in Costa Rica to have the app because there's a whole bunch of benefits there, right? This purple line is just the people that know about the app, just because often, actually, people didn't know about the app at the very beginning. But you can see that even people know about the app, and then they still wait a little bit to adopt. And the planner just wants everybody to adopt. This is the subsidy. And this is different than the rest of other literatures with complementarities. The subsidy is increasing over time. Why? Because the externality increases over time. There are more people adopting. There are more benefits left on the table. There is more to be grabbed, and the planner increases that subsidy to incentivize more people to adopt this technology. So relative to other technologies like vaccines, where we want to subsidize early, this technology, you want to subsidize later because the externality grows over time. And last thing, We think this could have implications. This is a first step to understand launches of other technologies like central bank digital currencies. Think about all these central banks trying to launch their own app, and they're trying to decide when to launch it, how to subsidize it, how long it's going to take for people to adopt it. So I think this is a first step to understand this type of decision. Okay, so that's what I have.